Hi, everyone. Welcome to Withum's annual Business and Finance Symposium. My name is Marina Gentili. I'm a partner here at Withum. I lead our global transfer pricing strategies practice, and along with that, global trade, supply chain, and tariff mitigation strategies as well, as you can imagine, is a very hot topic right along with transfer pricing these days. So, with me is
Manpreet Sangha. I'm a senior manager in our international tax practice, working on cross-border tax matters and working closely with Marina on these tariff mitigation strategies.
Great. We're excited to talk to you today. On the agenda, we're going to give you a bit of an update on sort of transfer pricing across the globe, then highlights of some tariff activity. As of this minute, it might change 3 minutes after we stop recording, but it's accurate right now. Then global trade disruptions on businesses, and finally the tariff mitigation strategies we've been working on, because I think it would be great to see if you think you can fit into some of these strategies or want to have a conversation about them. So, all right, transfer pricing across the globe, always a hot topic. Uh, I'm going to do a quick primer because I'm always going to find people that aren't super well versed in transfer pricing. So, just really bare bones. What is transfer pricing? Cross border intercompany transactions between affiliated companies around the world. Okay. And the term affiliated is loose, it is not 51 legal ownership. It's joint ventures, it's branches, it's 10% ownership, it's um, sister companies, right, along with parent sub. So sometimes, honestly, I would say in the world of tariffs, it could be completely unrelated companies that are now kind of colluding or having discussions around how they can improve their joint pain points and situations. So there's the domestic concept as well on the state tax level. We're putting that aside for right now, focusing on the global, but it's there, just so you know, and related to a lot of cost allocations in that category. Four main types of intercompany transactions. So it is not just products, tangible goods, which is the obvious, version of a physical thing crossing a border, but it's provision of services, and those could be strategic leadership services, R&D, business development, operational services. Doesn't end what type of services are out there. Licensing of intellectual property. So one entity in the global structure, usually the headquarter, the first entity, developed, designed, funds the intangibles, and others use it in order to engage in business around the world. So we need some compensation for that. And then finally, intercompany financing. So loans, cash pooling, loan guarantees. So really, it's these four categories. Everything else, a capitalizing a new entity or a dividend distribution, those are sort of Manpreet's area of telling you the tax impact, but they don't fall under the transfer pricing regulations. So the reason it continues to be a hot topic, there's a lot of room for tax arbitrage around the world, and tax authorities are now sort of coming together and figuring out, you know, sort of how to make sure that no one is evading taxes, that companies are not sort of trying to get away with paying taxes nowhere, right? OECD, the think tank, economic think tank, is a big contributor to that role. But now we probably have 150 plus countries of the world with transfer pricing regulations. Um, I'm going to let you in on a secret. Back in the day when the dinosaurs roamed about 30 years ago and I was in transfer pricing, we had 9 countries that had transfer pricing regulations. So obviously, just getting hotter every day. Once countries and tax authorities understand what it is, they want to protect their profit base as well. Highly regulated, highly litigated. It's the biggest tax uncertainty for multinationals and has been for many, many years. I would say there's currently now rivaled a bit with people who sell product in terms of the tariff situation, which we'll get into as well. So,
Yeah, and to Marina, to that point, right? Like all these transactions go to profitability and where it lies across jurisdictions,
right,
right? So as countries become more aware and more in tune with their tax base and protecting that tax base, they're pursuing these sorts of transactions more aggressively, right? So, anytime you're paying a non arm's length rate for one of those transactions to a vendor in a low tax jurisdiction, that erodes the tax base. So, a
right.
lot of concern around that globally. There some of us may have heard of Pillar Two, which is kind of a initiative to maintain a minimum tax base across the world or a minimum tax rate across the world. So a lot of action in this area.
Absolutely. Okay, so the on the U.S. side, there's a couple of U.S. points. The some big news is the IRS has adopted Amount B from the OECD Pillar One initiative. This introduces a new transfer pricing method. It's a simplified and streamlined approach, or the SSA, and it's very specific. It's for the sort of baseline marketing and distribution activities, sort of that limited function, limited risk entity. And the goal is, hey, we can elect this as a safe harbor and simplify our compliance and administration obligations. And this began sort of 1/1/25 in terms of taxpayers able to apply it. However, it isn't, it has its limitations, right? You might save a couple of bucks on compliance, but um, a lot of times you want to be a little more strategic about your transfer pricing. So you want something that's bespoke and really about your particular business. And then also in the world of product transfers, I think the tariff situation is going to tip that right upside down. Right now, we need to understand who our comparables are. So we need to look a little bit closer, right? Can we get information on the countries, their supply chain, right? Who are they buying from? What's their tariff position right now? And is it really a comparable firm if we have such diverse, uh, situations there? So that's just bringing up like a whole new thing to consider. Economic substance, there's always been an emphasis on that, but now it's renewed, right? So now it's a little bit less about formal structures, and more about like looking at the economic substance. What is happening in that market, regardless of how many people you have there, right? And what is the risk that's being taken by that entity? Um, and just kind of documenting all of that. Tax authorities are looking beyond the contracts, and looking at true value creation. They're also trolling websites, by the way. So when you set your transfer pricing, please carry it through your entire organization. Sometimes you have this sort of discrepancy around what's on the website or being posted in social media, LinkedIn, versus what your actual position is. And tax authorities are looking that deep now. Definitely increased litigation. I'm sure you've heard of all these cases, right? Meta, 3M, Medtronics, Perigo, just some recent ones that have had some traction. Um, but there's all kinds of litigation going on. So we want to make sure that we have, everything aligned in the middle markets. So obviously these are big names, right? In that middle market space, sometimes there's the misconception that, okay, well, we're too small and the tax authority is not going to be interested in us. But the truth is, uh, that's low hanging fruit, right? Like these cases takes millions of dollars for the IRS to pay advisors, transfer pricing professionals to build their arguments, and then they're taking these companies to tax court. There are so many steps before tax court, and that's where we like to live with our level of firms, right? Let's get something strategic, let's get something compliant, and let's make sure that we're avoiding things like cash traps and other aspects or unfavorable things around the world just because we haven't considered them, right? I get that all the time, Manpreet. I'm sure you do as well, right? Where hey, why do I have funds stuck in India and China, and why is it so hard to get it out? And my question is always, why did it get there to begin with, right? Like, let's take some steps back and make sure that our strategy is in place where we're going to limit, and get just enough in there, no more, no less, right?
Exactly. It's just that just enough, and finding that where that balance point is. I thought that point you made earlier, Marina, about your website telling the same story. I sometimes find where like a company will say their headquarters is in a particular jurisdiction, and kind of assert that right on their website, or say that they have offices globally. So then it starts to lend itself to the question of like, well, where should your taxable presence be as well?
Right.
So kind of having that conformity across all your channels becomes important.
Agreed. Agreed. So next slide, we'll talk about some other nations, right? UK, HMRC. Published a draft legislation for the first time around transfer pricing, permanent establishment, diverted profits tax, just all these sort of international tax rules. And it's the first time where they've provided more significant guidance to taxpayers around transfer pricing and expectations and what they want to see around that. So there's definitely an increased focus there on transfer pricing, tax authorities all over it. Um, EU countries overall, we're seeing trigger audits, right? France, Spain, but Italy, like a bunch of different nations. It starts in one country, and it seems like there's this ripple effect around other nations. Like, I don't know if they all have each other on speed dial and they're saying, "Hey, we just audited this company, you better take a look," right? I don't know, but it's just I've seen it many times over. In Germany, definitely significant changes, talking about the requirement to submit documentation within 30 days of getting a notification, talking about penalties that are in place as well. Italy had this new, they were not accepting loss making comparables for many years, and now they have an approach that aligns a little bit more with OECD, world standards, right? US, where, it's a reality. Companies do lose money in the industry, right? And so I do believe from a compliance standpoint, they should be in your comparable set because they're a reality. Now, if we're working on planning and we're trying to set what is a true sort of market rate, arm's length rate or profitability, we might remove them just to see what that looks like, right? Just to give you sort of this goal and this gauge of where you're really comfortably sitting in the range. But on audit, no, I will fight to the death that companies lose money unrelated to transfer pricing, and they should be in there. So okay, next slide. Talking through, I believe we've got, yeah, Ireland, the Abbott case on stock-based compensation, and needing to include it for cost-sharing arrangements and intergroup services. This is not the first case. There's a few out there related to stock-based compensation. So starting with Veritas back in the day, I think it's going to be more and more of a thing going forward. So probably should be starting that practice. Australia they've always been an aggressive tax authority in terms of transfer pricing, and now they're taking more of a approach around communicating, sort of the compliance approach and allowing, taxpayers just providing more guidance on doing their own risk assessments and mitigating risks. I heard from a very, very reliable source who heard from the international team at the ATO that they've declared a goal of 3,000 transfer pricing audits in the next year. So that's obviously big news, right? There's only so many transfer pricing advisors to go around, so they'll be sharing in this type of activity for sure. And then India, the finance bill of 2025. So a couple things happened there. One is taking a kind of block assessment, looking at sort of 3 years versus only 1 year. And then also, heads up on permanent establishment issues. They've kind of relaxed their standard of what could be considered a permanent establishment in India. So we really need to get advice there if we have operations in India. Withum is part of the HLB International Alliance. I actually lead the transfer pricing practice for HLB International, so we luckily have access to fantastic transfer pricing and international tax advisors around the world where we can seamlessly work together on these aspects.
And so, Marina, I was just going to say, in terms of
Yeah,
the India PE issue, they've effectively lessened the threshold, right?
right.
Like it's far easier now to have a PE in India, which again, that's a huge additional risk assessment for companies with any sort of presence in India, or frankly, even customers in India.
Agreed. Yep. And India also one of the world's more aggressive tax authorities, right? So whenever we're dealing India US, which is obviously quite often, right? Um, it's tricky because if you get advice from only an India tax advisor, they're going to tell you it's cost plus 17 to 24% markup, right? If for services, for engineering services without intangible ownership. If you talk to the IRS, they're going to say, no way, we're unraveling that instantly, right? It should be closer to 12, 13%, something like that. So maybe we need to compromise at 14, 15, to try to make headway and get somewhere because just going in completely in one direction over another is never a good idea. So a lot of trending things, U.S. and rest of world both. Financial transactions were ignored for years. I don't know if there was just a fundamental lack of understanding around them, or I'm not really sure. But they're here, they're relevant. There's a big renewed focus on it. Um, the question is, if a parent, let's say, is lending money to a subsidiary, we need to look at the financials of that subsidiary, right? Meaning, you know, debt capacity, right? Do they have the ability to take on this loan? Like, is it an actual loan? And then what is the interest rate based on a synthetic credit score that we end up having to calculate? Because let's not forget that subsidiary is not, you know, the parent. It's not the head of the global structure that has its credit rating and has, the ability to um, you know, borrow funds out in the marketplace, right? So you can't just take that same rate and use it for the sub. The sub needs its own rate. And then the other aspect to that is intercompany balances that people forget. You cannot accrue indefinitely on your financial statements, right? So at some point, it's deemed credit, right? You're lending to whoever you have the obligation to pay, and third parties would not wait indefinitely to get paid for the product or the service or whatever's happening. But Manpreet, you should talk about the impact, I think, on the interest and debt capacity situation because it has a very real, yeah.
Yeah, I mean, it goes back to your earlier point on the debt versus equity analysis, right? Like, what exactly is it? Again, if you're accruing balances indefinitely, is that more realistically viewed as an equity contribution. And then there's also withholding tax implications, right? So if there's a deemed payment of interest or a non-payment of interest or no payment of interest, is that something that requires interest to be imputed and then withheld upon? So there are these kind of knockoff effects in terms of whether something is characterized as debt or equity, and then in reality treated as such, right? So it there's an interrelation between even just the transactional component and then how you're capitalizing subsidiary entities that really has a practical effect as well.
Yeah, absolutely. On the transaction advisory space, we are in there a lot now in the tax diligence process. First, with transfer pricing, was ignored maybe 7 years ago, 8 years ago. Now it has a giant seat at the table, right? So either buyers of global businesses are getting savvier in terms of wanting to understand all the skeletons in the closet and what they're actually purchasing, or they're just looking for a reason to lower the purchase price. Either way, it's a problem. So we've seen the top things that delay the deals or impact the purchase price. Number one, lack of clarity as to where the intangible is owned, right? Where it's located. So sometimes, you think you're buying an asset in the US, but because you have an India service team of X amount of people, and because you've treated them as a cost center or not paid them at all, that India tax authority has now a very good claim that there's joint ownership. And this is really a cost sharing scenario, right? Where both the US and India own that intangible. Why is that a problem? you know, Funds flow around the world, profits flow to intangible owners, right? So ultimately, in the beginning, the costs all flow there, right? But once the product blows up, they're getting the royalties, they're getting they're profiting from the business, where everyone else is, kind of a limited function, limited risk entity. So one, the lack of clarity on intangible ownership. Two, no transfer pricing compliance whatsoever. So they're now calculating, okay, what's going on here and penalties, et cetera. Three, some kind of inefficient global tax structure. Maybe it's outdated, right? Sometimes, Manpreet, I know you know this. We walk in and they have a global tax structure in place for the last 20 years, but nobody at the firm was around 20 years ago or remembers why it was in place, and tax laws have changed, and that needed to be revisited, and it was not, right? So that's part of it. And then this is always my favorite, and this has happened more than once, where there's a discrepancy in what the transfer pricing document says about transfer pricing, what the accounting says about transfer pricing, and what the intercompany legal agreements say about transfer pricing. Those three should all be the same, right? There's literally no reason for them to be different. But something went wrong when they're not all the same. And again, that creates a lot of confusion, right, in an audit situation.
Yeah, and I'll say also like the icing on the cake will then be like PE risks, right? You have
Right.
people all over the world that are doing things, and that usually comes out during diligence. You paid contractors, or you viewed as contractors, but you had a dozen of them sitting in a particular jurisdiction. So really, sometimes it's a surprise to everybody, right, that this
Yeah.
risk even existed at the target company. But it's absolutely, as buyers become more savvy to it, and they realize that there's real income tax exposure as well, that really is open until it's addressed. It's absolutely been coming up more frequently.
Well, it's also nuanced, isn't it? Right? Like these companies, tax authorities are viewing every company as if they're just like engaging in tax manipulation via tax rate arbitrage, right? They just have this preconceived notion that that's what's happening when the reality is, we got companies that are just trying to like expand globally, gain efficiencies, get their product closer to customers, right? Not understanding that there's this whole level of like sophisticated, deep rooted international, tax regulation out there, and we need to really, make sure that they're sort of on the right side of that, right? On the PE arena, we see a lot of, you know, the someone at the U.S. entity signing contracts, engaging, or someone at the sub, let's say, signing on behalf of the principal entity, right? And then that sort of becomes a new drama, around PE. So, okay, U.S. and rest of the world as well. The impact on tariffs, right, in the global transfer pricing model. There's new, higher uncertainty around tariffs. Um, Definitely between the major world economies, right? But the U.S., I think, a US business sitting, a distributor sitting in the US importing product is going to take the biggest hit, that importer of record. And let's make this clear because I think a lot of times there's just a lot of noise out there and lack of clarity, right? The entity that is 100% on the hook for paying the increased tariff is the importer of record. That is typically the distributor, let's say in a related party situation, it's the distributor operating in the US in this example, right? That is buying product from its related party or independent party for that matter, somewhere outside the US. So as it's importing that product, it's not the the exporter that is getting taking the hit. It's the US business that's taking the hit. And then they have to, figure out what to do with that, right? Can they diffuse this, right? Can they pass along some of this cost to the consumer? And sometimes the answer is yes, and sometimes the answer is no. It is very dependent on the facts of that particular business, industry, etc. Can they renegotiate a vendor agreement? Probably not, right? I mean that those are like long agreements that can't be unraveled that quickly. Um, so it's really important to understand like your position in the supply chain. So what's happening now is there's no real way to change the tariff, okay? And yes, it's fluctuating and shifting, and Manpreet's going to take you through sort of key highlights of, how it's been moving. But the truth is, at the end of the day, it's going to be higher, right? So whatever that is, we want to try to mitigate that, and there are ways to do it. It's not by changing the tariff amount, it's by changing the dutiable customs value, right? How do we organically lower that value with the strategy, with economic justification, quantifiable, that can be explained to customs and border protection once they notice the change, because they will. I mean, they're on it right now, looking for these changes. So, um, okay, yeah,
So,
next.
so with that, yeah, we can kind of move into some highlights of how the timeline of how we've gotten here, and seemingly it started kind of at the beginning of the year when the new administration came in, but April 2nd was Liberation Day, right? So that's when the tariff imposition began. Um, and the tariffs are kind of imposed under a couple of different authorities. One being Section 232 tariffs, which are more of your national security related tariffs. Think of steel and aluminum related tariffs, and then the other being IEPA, which is that executive power tariff, which is currently working its way uh, through the courts and is actually slated for oral arguments in front of the Supreme Court November 5th. So that's kind of like the overarching of how we've gotten here. But these next couple slides will take you through some key dates, um, and we can actually flip over. So as you can see through May, there's some movement in terms of potential new tariffs and changing of rates. And I think at that time, Marina, we were on the edge of our seat on a daily basis, right, seeing
Right.
which direction it was going to go in, whether it was going to be 150% or 15. It seemed like a bit of a roller coaster ride through May, and then those summer months. Um, Take you through some more key dates here. I think the key one here is again that Canada, Mexico, USMCA. We'll get a little bit more into that a bit later. But again, really it became a bit of a maze in terms of what what agreements were going to be respected, which ones were basically being overlooked and tariffs being imposed anyway. The automotive sector was in a bit of a bind earlier this year as well, so we've gotten a bit more clarity there. This takes us through some additional dates. September 9th being a key one for the IEPA tariffs. They were found to be unconstitutional by lower courts. October 1st, there was some activity in the pharmaceutical space, which caught the attention of pharmaceutical companies, some of which have, you know, engaged in their own direct discussions with the administration. I'm sure you've heard in the news, right? So we have some inbound drug companies that are, planning investment into the U.S. And again, we'll talk about some strategies in that near-shoring sort of approach to mitigating tariffs. Jump to the next slide. So these are kind of the anticipated dates coming up here throughout November. The IEPA tariffs again being addressed before the Supreme Court, oral arguments this week, and so we'll see how this turns out. Could be a big consequence, right? Because tariffs have been collected under this authority, so a lot of companies have a huge stake in the outcome here, um, and understanding kind of what impact it could have on their cash flow. So again, the last bullet point here, these tariffs are seemingly, getting the result the administration intended for, right? Which to bring back some, manufacturing investment in the U.S. But again, the companies that you're hearing about that are able to successfully, do that, the numbers aren't small, right? So it's taking huge capital investment, and it's not an easy, uh, you know, plan to mitigate, but it is a potential.
I also just want to throw in that, yeah, this is an immediate problem with a longer term solution, right? In terms of actually, building a plant here. So some are in the process of doing that, for sure. And, that was part of the intended effect. I won't say that was all of it. I think, a lot was just sort of political bargaining power negotiation, and tariffs was just an effective tool to do that. Um, but I also want to say because it's applied so across the board and broadly, with few exceptions, there are these categories of companies that maybe they're domestic only, and maybe they have eight manufacturing plants in the U.S. and they're building a ninth currently, but their raw materials need to come from outside the US because they simply don't exist here, right? Like sophisticated manufacturing machinery. A lot of that comes from Germany. A lot of that comes from Italy, right? There's this, and so they're getting hit, with both the increased tariff on these really costly machines, even though they may not be an international company at all, except for the you know manufacturing products needed for the line. Um, and then just really not having any recourse, around that is really interesting. Now, of course, there's always consulting with attorneys, private letter rulings, etc. But those are taking a little bit longer these days than in the past. So yeah, I know I find it interesting that there's just this inadvertent hit with no real recourse for the companies that are, I'm going to say, doing the right thing, doing what we're trying to encourage here in the U.S., which is to, near shore, onshore the manufacturing.
Yeah, and, there's also one more recent date as well. So there's a 1 year trade truce with China as well. So that for whatever that's worth, that should be helpful in terms of pricing and planning. Um, but as we've all seen, right, it's just been a very uh, dynamic year, and I think
Right.
initially Marina, I think some of our clients were hoping it would just go away, right?
Yeah.
And with the frequency of announcements, they were hoping there would be a great announcement at the end that it was all going away.
Yeah.
But I think as it comes into focus, I think we can all appreciate that this might be a long term issue or longer term issue, right? If there's a 1 year truce, that should put into perspective how long the road is ahead.
Yeah. Absolutely.
So
I like these
what we
snapshots. I like these snapshots. Right. You just got it all in one photo.
these snapshots are super helpful. So what we have here is actually a CBP issued snapshot of where the tariffs stand. Now this is was updated August 20th, so from earlier this year. But it does a nice job of kind of breaking out along the top those Section 232 tariffs, which have been tested a bit more in terms of their legitimacy. So those are kind of identified at that across the top there, and then those IEPA tariffs across the lower two rows, right? So just a snapshot here. Again, these rates are dynamic. It seems like they were changing pretty frequently over the summer months, um, but a really good way of summarizing the information here. And then on this next slide, which is mentioned on this slide as well, the de minimis exception, right? So effective August 29th, the de minimis exception no longer applies, and that exception was really important for many inbound companies that were just selling into the U.S. with no real presence here, right?
Yeah.
They could, if you're a clothing manufacturer, you could mail a $200 shirt into the U.S. With no issues because that de minimis exception um, at goods valued $800 or below, with just no duties or taxes were applied. So the removal of that de minimis exception has been a huge has had a huge impact on companies that were just shipping into the U.S. Without much of a presence here, because now they have to deal with duties and tariffs. And I think over the past decade, like the number of packages that were eligible for this de minimis exception, like exploded, right, to the tune of tenfold. So
Right.
it's been something that importers have really utilized, and it's also wreaking some havoc on parcel service companies, right? So it's had a pretty far-reaching impact. There are some exceptions which are noted down at the bottom here, donations and informational materials. But again, it's like if you're in a commercial setting, um, that's not going to do much for you.
So yeah, international businesses of all sizes that are engaged in importing, exporting products between the U.S. and rest of world need to be prepared for these disruptions. Okay. It's the physical flow of goods. So it doesn't matter if, there's no legal or economic ownership or anything along those lines. It's a physical flow across a border that's subjected to these tariffs. Tariffs are a tax. People don't always sort of think of them that way. We hear them as, increased costs of doing business and, a sort of political thing, but they're a tax. So just like with transfer pricing, you can't drop a customs price because the tariff went up. You need the business reason, you need the economic substance behind it. Okay. So, I had so many calls in the beginning. Hey, I'm just going to dump my, I'm going to sell below cost, or I'm just going to dump my product price. Nobody's going to notice. They will notice. I assure you that they will notice. So, there's a lot of challenging questions. Are the tariffs here to stay? Will they continue to increase? If this administration changes its mind tomorrow, what's going to happen? What happens in a couple of years when the new administration comes in? I don't think that tariffs are going to be very quick to unravel. I'll tell you that. I don't really have a crystal ball in all of this, but I think that this is a little bit longer than just this current administration. So. And then they vary by, like we talked about, amount, country, industry, company, and product, right? So maybe a well diversified business that, procures product from different services, different companies, different vendors, they might not suffer as much because they're diversifying between the countries and the ultimate tariff rates. High demand, a business selling a high demand product like maybe energy won't be um, impacted as much. Uh, so that's, the consumer needs the good, they're going to pay for it, right? Versus if it's a product that you can go without, you might skip it. Your favorite cookie from Canada, you might have to eat Oreos, right? But it's all about the bargaining power in the supply chain, right? The Walmarts, Costco's, Home Depots of the world, they're not looking to share in the tariff increase, right? They want the product, same place, same time, same price, when they need it in the warehouse. So um, the tariff impacts on businesses is related to both related parties and independent parties. Um, it's it's a weird dynamic where now we've got customs revenue increasing with the increased tariffs and increased dutiable value. But what does that really happen to now income tax, corporate income tax, right? That's naturally going to decrease. And I'm concerned that no one's really thinking that through or talking about that much yet. Because if you're a related party scenario, you're going to fall outside your range, right? Your arm's length range of profitability. And then what, right? It'll be deemed a transfer pricing issue because I don't see the IRS saying, "Oh, cool, you gave that revenue to customs, we're good." You could just kind of keep moving on. So, yeah. Anyhow, more complications than probably we realize. So, next slide. I, you know, just impacts on the bottom line, right? Distributors typically have thin margins to begin with, right? They're not super risky companies. They buy a product, they sell a product. Um, so, I think we're going to get the consumer, I think we're going to get smaller companies, having this sort of ripple effect where if they can't pass along to the consumer, they may be going out of business or falling, outside profitability ranges. Um, and if they can pass along to the consumer, we're just paying higher prices for the products that we use every day. I mentioned the complications in the transfer pricing analyses, the benchmarking, and I just mentioned the falling into the outside the range. So I think a lot of non-compliance and tax controversy is going to come up here. Um, why don't we move
Yeah,
forward, Manpreet? Yeah, yeah,
we can. I'll jump to the next slide. So the distributors, I feel like, are seeing the most pain in terms of
yeah.
where they're buying from an unrelated party, and their margin is slim to begin with,
Right.
and they're just not right. They're really between a rock and a hard place. So it'll be interesting to see kind of what tools are used there.
And the regulated industries, like some of my pharma companies can only pass along, a couple of percent of the 25%, increase to consumers. Um, so, all right.
Yep. All right. So with that, we'll kind of move into kind of the interplay with tax, right? So the Internal Revenue Code section 1059 Cap A actually mandates that um, the amount the amount that's used to compute cost of goods sold cannot be greater than the amount of cost used in computing the customs value, right? So it requires kind of an equivalence between the two amounts. And to deviate that, it's not to say that the two amounts can't deviate from one another, but there needs to be a reason, right? So um, that's kind of where the statutory authority comes in, where the IRS can come in and basically make an adjustment to adjust your cost of goods sold. But it's outside of customs regulations, but it brings the two together. And it becomes particularly relevant when you have a U.S. importer of a good that's dealing with middlemen, right, between where themselves and where the good is actually being manufactured. So Marina will get into that concept a bit more later, but this is the statutory framework on the cost of goods sold side, and it kind of creates this tension for some clients, right, where they may have beat considerations
Right.
and considerations around wanting cost to be in cost of goods sold. Now that may not look as favorable uh, if they have to increase their customs value. So there's a couple different you know concerns at play here, but this is the authority that allows the IRS to come in and adjust that cost of goods sold number downward to match your customs value.
And I think this is a great time, Manpreet, to make it clear, like, this is a collaborative approach all around. Like, at the company, this is, a time where the finance people, the tax people can't solve this by themselves, right? They need to knock on the doors of the operations, logistics, supply chain people, right? And they need to kind of talk through and how this works and what makes sense. And same on the advisor side, right? So a lot of people think customs, so they're like, "Oh, I'm going to my customs broker to discuss this topic." Well, a lot of times your customs broker is the compliance person with CBP. They're not necessarily strategists, and they're certainly not like global income tax transfer pricing people where there's a huge impact there. And then a lot of times we need attorneys to come in, like if we're changing the customs valuation method or have some kind of, audit from CBP or need a private letter ruling, right? But the advisor side, like the Withums of the world, the transfer pricing and tariff mitigation consulting people of the world, we're looking at like the whole business. We're not stopping at, that top level customs value. We appreciate we're the trusted advisor for this business. We know the business well. What's the ripple effect, right? What is this going to do to the bottom line? Can we rework the supply chain? Can we, um, do something that will sort of mitigate the effect of these tariffs? And so I think in a lot of cases, you need some combination of the three, right, to kind of get it right. And then tariff mitigation strategies. This is
Tariff mitigation strategies.
exciting space right now.
This, so tariff mitigation strategies. What we have up here is a couple frequently asked questions that we have our clients coming to us with. The most frequent, and again, the frequency of these questions has diminished over the summer months as the picture came into focus. But one, can I be exempt from tariffs? Maybe, but not likely. There's some free trade agreements, right, like USMCA, that can come into play here. But then there are other, tariffs like these Section 233, 232 tariffs, which could layer on top of that. So it's complicated, but you start with the baseline of probably not, right? So that's kind of the short answer there. There's some other options which could, again, mitigate, but the baseline is no. Can I get a refund on the tariffs paid? Uh, Probably not again, but maybe if there's a calculation error. Overall, the refund programs, again, for the 232 or these IEPA tariffs, not going to apply. Can I delay tariff payments? You may be able to under the Customs Reconciliation Program, but again, this is another strategy to use, and not something that's available by default. Can I lower my customs price? Not just because of the tariff increase, right? But potentially, if there's a reason to, right? If there's upon further analysis, there's more that's going um, into that customs price than you previously thought, and maybe hadn't looked closely at it or scrutinized it, because maybe it wasn't as relevant, right? But in this current environment, it's becoming increasingly relevant.
So, right here for this bullet, we are speaking to the people that have no real transfer pricing strategy, like in a strategic way, have never done a transactional approach to transfer pricing. Maybe they just have, okay, we transfer our product at this amount, and that's all they do. So they haven't considered services, royalties, other aspects that could be embedded in that product price and not dutiable. So now's the time to get granular. Like, let's look what's in there. And why didn't they do it before? It didn't matter, right? Like whether they called it a product or, something else, maybe it just didn't matter as much, but now it does. So let's take a look.
Yeah, or is de minimis, or but whatever the reason was.
Yeah.
Um, so now's the time. Can I sell my product below cost? No. So I think that's the short answer there. Does the de minimis exception still apply? No. So again, that's a major change, and it impacts a lot of shipments into the U.S. So what do we do now? Again, to Marina's point, now is the time to kind of assess transfer pricing policies, get everybody on the phone, finance, tax, operations people, logistics people. Um, Again, discussing where your product is coming from and how it's getting here, and then who's acting as that importer of record, right? Because they're the ones who are responsible for paying the additional duties. So just identifying everybody that's in the supply chain, where your goods are moving through, uh, how you're getting your goods pursuant to which contracts, right? Who are the purchase sale agreements between, um, and then understanding if your customer can bear additional cost, right? And whether that's another negotiation point or a conversation directly with the customer. Um, and again, just kind of working with your consultants, CPA firms, customs broker, trade attorneys, just understanding what are the options, and like where does your supply chain currently sit, and how could it be made to be more efficient? Do you need to bring goods into the U.S. that are going to eventually be exported out of the U.S.? And so just answering these fundamental questions, about the supply chain, uh, that's a kind of the starting point for formulating strategies.
Manpreet, I think we're running out of time here, so I'm trying to be very cautious of it. Why don't we kind of start picking up the pace on the next couple because I really want to get through them.
Okay, so there's this concept of uh, tariff engineering, right? And kind of identifying your HTS codes and making sure that the correct code is being applied, and that the good is being categorized appropriately. Because again, that's what your tariffs are essentially based on, right? And that sets baseline that baseline rate. So working to ensure that your HTS codes are correct, and that everyone agrees on the code being used. Again, tariff engineering, it's a legitimate assessment of how your goods are being categorized, and ensuring that it's the correct code. Not necessarily moving into a code that doesn't align with the facts of the good, um, but it can, again, it may not have mattered 5 years ago what code you were using, but it's becoming increasingly relevant today. So ensuring that those codes are agreed upon amongst the parties, and everyone views it as being the correct code. Advantages, again, reduced cost. Um, if you're in a lower dutiable rate, that will reduce your duty cost. And again, navigating the regulations uh, in international trade, that could be another advantage. The disadvantages, again, that potential for non-compliance. You do not want to misclassify your goods, because that could be an issue. So again, kind of having it assessed, and ensuring that the various people in your supply chain agree with that. Again, that increased complexity, right? Getting granular into the good, and seeing what exactly you're dealing with, and is it more of this than that? Potentially, there's a different code. It also lends itself to disputes with CBP, right? They may have a different view on how it should be classified, so that's just another thing to be mindful of.
Great. I want to get into first sale for export rule. I think this is really critical, and I think this applies to a lot of our multinationals, third party independent structures, and related party structures both. Easier to apply in a related party structure because the level of information needed is pretty granular. So obviously, you have a better chance of getting through that when you are related entities. But this is what it's not, I view it as a safe harbor. Those aren't the actual words used, but it effectively, CBP is giving multinationals a way to have their dutiable customs value lower than their actual transfer price in their financials. Okay. So nothing changes in the transfer price. That just keeps on going the way it's going. But there's this exception in terms of the dutiable customs value. And really, how it works is when there's a middleman scenario. So if you see from the drawing, you have a factory or two in this case that sells the product to the middleman and then sells the product to the distributor importer of record. Okay. And by the way, it has to be a legal and economic sale, a bona fide sale, meaning that middleman needs to take ownership, risk. It does not need to take possession, though. So you could have a flow from the factory, let's say, to the US distributor, but the company in between does need to actually take ownership. And what happens is, so this US importer of record, instead of buying at the marked up price of that middleman, they can buy at the factory price. So the first sale, the factory price to the middleman, that could be the dutiable customs value. As you can imagine, this is an extremely attractive um, uh, you know, uh, strategy for multinationals selling products. We work on this a lot. It's very successful because CBP, it's out of CBP. They're calling it. They're telling us this is acceptable. So we use this as much as we can. The thing about it, if you go to the next slide, is it's very specific what the criteria is. So we need to make sure that we're meeting all this criteria and we're supplying it at the ready. So we have that customs sort of audit type of memo, so that we're ready to go. So one is the bona fide sale, the way that I mentioned before, and you're getting these slides. We won't go into all the detail in the interest of time, but one is that sale. Two is the goods need to be clearly labeled as going to the US, and you need proof of that. So it's invoices, it's purchase orders, it's financials, right? And settlement. You need to show all those things that those goods are destined for the US and getting there. And then the third is conducted at arm's length. So we're coming in and doing the transfer pricing valuations related to these scenarios and supporting that.
Yeah, and you want to think of from a tax point of view, Section 1059 Cap A, right? Because this is where your customs value will deviate from your cost of goods sold. So there's a body of case law and private letter rulings around this, but this is where you really see it um, shine.
Yeah, and sort of CBP has given us an out to deviate, right? That's what I feel like the first sale for export is, that's your out. That's your sort of how you're ticking and tying around that. Manpreet, I think these should be quick. We did cover USMCA before, and these slides provide a whole level of detail. So I would say kind of skip forward and let's get to some meatier things. Um,
Okay, so another tariff mitigation strategy we'll run through lowering that dutiable product price. So again, this the dutiable product price again is kind of based on transaction value, and there's a couple different um, methods that can be used to figure out that transaction value. So I'm going to move through these somewhat quickly as well. So there's this concept of assists in CBP regulations, and from a tax point of view, that's kind of the additional embedded items into that product, right? And like how you would parse that product into its segmented pieces. Um, so we've laid out some things that used in the connection with the product that you could potentially parse out and identify separately. Now, some of these aspects are so integrated into the product that you can't really uh, compartmentalize them. But that's kind of the concept here in terms of like lowering that dutiable product price and saying, well, of this product price that has been, let's call it 10, you know 2 is actually related to this non-product related aspect, and really parsing it out. So that's kind of what this strategy is kind of getting into. Another strategy: nearshoring, friendshoring, manufacturing. Again, an aim here seemingly is to bring manufacturing back into the United States. Not an easy endeavor for a lot of companies in the U.S. Again, you'll need to deploy capital, and then it always lends itself to the question: well, if you're going to build a warehouse in the U.S. or build some sort of manufacturing facility, where do you get the steel? Where do you get the equipment? May not be available here. So it seems like a plausible or simple solution, but in terms of actual implementation, it can become a bit challenging. Some of the benefits and risks associated with that, again, I think the benefits clearly are there if you could get your facility up and running, but thinking about how long it'll take to get to that point is another issue. And whether that's actually viable. But then the risks, I think, are also equally important. The instability and the economic risk around it. It's just difficult to say for sure. Whether 2 years into constructing a facility, whether or not that'll be worthwhile, or what the environment will be at that point. It's hard to say.
Okay, the next strategy would be sort of switching up the supply chain. So, a lot of times companies will have, that are sort of Asia Pac or European headquartered, will dip their toes into selling to customers in North America by, setting up an entity in one country instead of all of them, right? So, Oftentimes it's the US, sometimes it's Canada, right? Depending on the situation. So we have a lot of companies now that are importing product into the US, but it's destined for Canada or Mexico, right? So now the question is, why do we want to do this? And does this still make sense? And of course, it depends on the product, USMCA exemptions, et cetera. But for the most part, we just need to rethink this. And does it make more sense now to set up either a 3PL or a related party distributor in Canada and have its own supply chain directly to the vendor that's in China or wherever, we're located. And that could make a lot of sense. It won't make as much sense in Mexico, I'll tell you right now, and that's just because Mexico has a very high tax rate at 34% and a 10% mandatory profit share for employees. So just in general, the cost of setting up an entity and doing business there is more cost prohibitive. So you might be better off taking the tariff hit at that point, but we don't know because we need to kind of, it is the ripple effect. We have to go through all the scenarios to get through it. And then transfer pricing benchmarking, right? Now we're looking at them again and being a little bit more strategic. We're applying them now for a different reason. So, is there room to support, if we're looking at a gross margin profitability analysis, is there room to lower that dutiable customs value yet still be in the range from the U.S. Standpoint? Um, considering whether the transfer pricing is still appropriate, right? Should the limited risk, limited function distributor bear the entire cost of that? In a transfer pricing scenario, should they bear the entire cost when they're not the principal, they're the limited entity? Yeah, so just a lot of like we need to learn more about our comparables, which is going to be very complicated. Let's get to the next slide. And then bonded warehouses or free trade zones is another option. But bonded warehouses are very specific, and they are cost prohibitive for most people. So you have to be of a certain size to take advantage of a bonded warehouse. And it really just means that products that are then coming into the U.S. but destined for Canada, Mexico, wherever, they're wrapped, they're bonded, they're reflected as not actually entering the US, right, because of their packaging, and they will then be carried in a very specific vehicle um, to the other country. So it again, a lot of things around getting it done. Not a lot of companies are big enough to do that.
The reconciliation program we've outlined here, again, it basically provides a delay between when the goods are imported and when the customs are actually due. There's a handful or less than four reasons here why you can you can say that your customs value is indeterminable at the time of import. Again, this is a program that you need to be you apply for and be part of. Right, it's not something that you just assert on your own, um, but it's voluntary. So it can be beneficial if there is some uncertainty. Like are there assists that are embedded into your product price that haven't been scrutinized before? So maybe there's that's the reason that you can't determine that customs value, but it is a program that should be considered, particularly if there is some uncertainty around what's embedded in that value. Some advantages and disadvantages of the program. Again, one of the like most disadvantages that we've highlighted, that complexity around the program.
You need a team in house that's really working on that reconciliation and keeping it tight. So there's a lot of activity and compliance around that. And then wrapping up with just a visual of this collaborative advisor role that we mentioned earlier, right? So, um, customs broker, customs trade attorney, and Withum or any transfer pricing advisory firm, right? So all three can talk high level. We can take those 30-minute complimentary intro calls and talk through sort of what are the specifics of your business and whether or not we think we can help, right? So the second piece is very CBP procedural. We like to leave it to the customs broker. Clients typically have customs brokers, right? So, they're going to get that information there. That is like very sort of well documented. I would say any compliance for CBP. The next category is any kind of legal action, and we're going to leave that to the customs and trade attorneys. Um, Manpreet and I align with attorneys quite often, depending on the case we're working on. Sometimes, it's just a little bit of a, just kind of gray area, right? So we want to get through that. And then the final category, that's all us. That sort of economic analysis, write up, business substance to lower customs value. We end up getting hired by law firms and customs, strategists, right? Like to do those analyses because it's not their area of expertise. So we're the ones who then quantify that. Here we are, next slide, myself and Manpreet. Here's our contact information. Um, obviously get in touch anytime. We're always willing to meet you, to talk through, and see, if we can help. And a lot of times these seem to be therapy sessions, like, yep, you're on the right track, doing the right thing. Other times we can propose real strategies that can help. And then other times, honestly, we can just prevent you from inadvertent fraud because there's a lot happening out there that, really shouldn't be happening. So it's just important to have those conversations. Thanks for joining us, everyone.
Thank you.
Yes, the world has turned a bit upside down in terms of global trade and increased tariffs and increasing uncertainty. And whoever thought this would be part of the diligence process as well, but it really has to be, right? When you're acquiring the global business, you need to understand what you're buying. And now it's just a whole new world. I mean, the transfer pricing's been big over the last sort of 5 to 7 years, where it was ignored before, and now the tariffs are going to be just as big. We need to ask the questions.
That's really interesting how with, tariffs entering into the picture for deal makers and how they're looking at opportunities, obviously not just global businesses, it's, U.S. based businesses with customers strictly in the U.S. But I think the real interesting part to me, it's not just that they're importing goods or sourcing a big chunk of materials. You kind of got to go backwards in the chain and understand where these materials are coming from and what the impact of tariffs is.
Yeah, absolutely. Right. It just changes the dynamic of the cost of your product, right? And how much can you really pass along to the customer or not, right? It's hard to tell. Everything is very case specific, but never before have companies themselves, not just, the acquiring company that needs to know, but the company themselves need to really make sure they understand fully their supply chain and how that works. And then, obviously a company interested in them as a target acquisition needs to understand it as well. It's crazy. And that's whether you have a related party channel of, through your supply chain, or you could be purchasing just from a third party manufacturer in China. You don't have to be a global business. You could be selling in a US company selling into the US market, but your supply chain is coming from overseas. And so it now dramatically impacts.
Yeah, absolutely. Well, great stuff, Marina. And we could talk about this for hours, I think, because it's really so complicated. And again, you've, with the addition of the tariff discussion recently, dived into this issue and really have a great grasp of it. So with that, I know Since things are changing by the hour, you're very
Yep.
busy, and appreciate your time talking about this on the Capitol table, and to our audience. It's a lot going on, and it will continue to move. And I think maybe to emphasize one thing Marina alluded to, that this is here to stay now, and regardless of what happens with the final determination of tariffs, percentages, countries, movement of goods, etc. It's going to create movement and issues to address. But with that, I think you also said opportunities to structure it
Always.
optimally.